Hello, in this lecture, we're going to define expense recognition. According to Fundamental Accounting Principles, WILE 22nd edition, the definition of expense recognition, also known as the matching principle, prescribes expenses to be reported in the same period as revenues that were earned as a result of expenses. So the idea of expense recognition or the revenue recognition principle is, when do we recognize those expenses? For revenue recognition, we recognize revenue when we have earned the revenue. When we think about expenses, we can think about it in a similar way, meaning we're going to recognize expenses when they have been incurred. But because the goal of the business is really revenue generation, what we're really doing here is we're matching those expenses to that particular point in time that they were used in order to help us achieve that goal of generating revenue. If we look at an example of this, we can say we're the owner here on the right-hand side. We are receiving legal services and we are giving an IOU. So we have not yet paid for the legal services, but we have consumed the legal services. The work has then been done. If we compare and contrast what would be done under a cash basis or an accrual basis, under a cash basis, we would say that there would be no transaction at that point in time. Cash has not been paid. It will be paid in the future. Under an accrual method, we would say that we should recognize the fact that we have a liability because we have consumed the services and we owe the money in the future. Therefore, accounts payable to liability would go up and the expense would be recognized at this point in time, at the point in time that we have consumed the services. Why? Because we're consuming those legal services to help us generate revenue, the goal of the business, in that particular point in time, even though cash has not traded hands. That presumably would happen in the future.